Freedom Show. My name is Rob Berger, and yeah, the markets are kind of exciting. Are we having fun yet? They were down today. Yeah, S&P down 1.69%, and I wanted to talk. I want to sort of start the live show just chatting a little bit about that and interest rates and total return versus sort of income or dividend investing. So as folks start to enter the chat, if you can just give me a thumbs up that, you can hear me and see me, that would be appreciated. I see. Oh, VJ, the very first, this is just a good sign. The very first comment is from someone from Michigan. All right, good. I think I got a thumbs up. And already the questions are about bonds. Yeah, I know. It's not good. All right. So I wanted to I'll get to those questions real quick, but I just wanted to give you my 2 cents on interest rates, the market. I sort of titled this total return investing versus income or dividend investing. And as longtime viewers know, I am a total return investor, which means I don't have a particular, I'm agnostic, I guess you could say, when it comes to whether, the dividend itself. And I think about it, here's a rule of thumb. Whenever I start to analyze a stock or an approach to investing that in my mind is different than how I would think about owning a real live business, then red flags go up. It's like, okay, something's not right here. So a good friend of mine, a couple of friends actually, when the market goes down, they start selling. And I'm thinking, well, I don't know, if I own my own business and someone walked into the store one day and said, yesterday I would have paid you $1 million, but now I'm only going to pay 800 grand. Would I just dive for that and sell? No, it's not how I would think about my business. It's not how I think about the business that I do have. And the same thing then would be about dividends. If I'm thinking about my own business, how much do I want to reinvest back into the company? And how much do I want to take out? I mean, that's it. That's what a dividend is. It's saying, okay, Apple, we don't need all the cash we have, so we're going to give some of it back to shareholders. And so, my approach has always been, I want them to take the money they've got and put it to its highest and best use. And if that's hiring more employees, hire more employees. If it's making an acquisition, oftentimes it ain't, but if it is, fine, make an acquisition. If it's buying back shares, great. R&D, whatever. And if it's dividends, that's great. That tells me you have no better use for the money. And then I do want it back, because the last thing I want is, some management to do something stupid with my money and your money, so that when they're at the country club on Saturday, they can tell their friends how big their company is because they've just made some stupid acquisition. They would probably describe it a little differently than that. So what I'm focused on is the overall total return. And when it comes to the price of a stock or a fund, it's going to, of course, go up and down. But it and significantly, and as we're seeing now, it kind of gets us to the one thing we've been talking about this here on the show for months, that when interest rates, we didn't know when they were going to go up or what was going to cause them. We think, go back last year. So it's before the war in Ukraine. It's, but even before the inflation numbers we're seeing. And we talked a lot about it. And it was, look, when interest rates go up, asset values go down. Just what happens. And it doesn't matter if you're talking about real estate, Bitcoin, or stock or a bond, right? Asset values go down. Now, it doesn't always work in lockstep, and a lot of other things can affect it and all that sort of thing. But that's what we're seeing. I mean, I was looking at the 10-year now. I mean, it wasn't that long ago we were trying to get the 10-year over 1.5. And now it's at, 265? Here we go. 2774. That's where the 10-year is now. So, you can look at it. I mean, goodness, it started 2022 at about 1.5, 1.5, then 1.6. Interest rates can change very, very quickly. And actually, look, it was pretty low here. It's jumped 1% in a month. And stocks are reflecting that, particularly the stocks that were higher in valuations and lower in, in profit. That's why you see ARK, and among other reasons, getting crushed. Not to pick on ARK, but So there's sort of I'm throwing sort of a lot of different things at you. This is what's just been on my mind. The reality is, we need to buckle up because, it's as interest rates continue to rise, I assume they will. I do want to show you this though, about predicting interest rates, and then I'll get to your questions, they're already pouring in. So this was a paper I found this week, or maybe one of you sent it to me. I can't remember where I found it. Doesn't matter. Here's the paper. It's on interest rates. What I want to show you is that chart, but here it is in case you want to Google it. Interest rate volatility, part 1, considerations in predicting interest rates. And basically the paper says, yeah, we're not very good at it. And I thought this chart was fascinating. And I forget where they pulled this data from, but these were various predictions of the 10-year Treasury yield. And the line, the orange line, that's what the actual, you can read it here. That was the actual yield at those different points from 01 pretty much to the present. And the green dot was the high forecast, blue was median, and this red circle was the low from a number of different sources. And as you can tell, the professionals aren't very good at predicting interest rates. So even now, as we sit here and we think, well, goodness, interest rates are going to go up, right? That would be my prediction, but that doesn't mean that that's what's going to happen. And it also doesn't mean that it's going to go up like this. I can still remember in 1980, I want to say it was 2, I had some CDs. I invested in a CD at the bank, and I was getting 16% on a 6-month CD. And you might say, well, Rob, that's terrific, I guess. Of course, inflation was high, but why a 6-month? If you've got 16% on a 6-month, you're probably getting 17, 18, 19, 20% on a 5-year. Why didn't you lock it in? We were all afraid interest rates were going to go up. Yeah. It sounds crazy given today's interest rate environment. If we could just snap our fingers and have 16% FDIC insured, we'd probably lock it in for eternity. But back then it was like, who wants to be the knucklehead locked into a 5-year CD at 16% when the rates have just jumped to 8, or higher, when the rates have just jumped even higher? Yeah, perspective, I guess. All right, enough chit chat. Let's see, the first one, well, VJ was the first. Here is his winner is total returns. All right, I like it. Yeah, one other comment about that. Imagine you have 2 investments and one has a total return of 8% and one has a total return of 10. Which one, and we can say the volatility is the same or similar. Which one would you prefer? Well, I don't think anyone's going to choose the 8%, over, let's just say it's over a 10-year period. But that's effectively what you're doing if you say, well, I prefer the 8% total return because it has a 5% dividend yield. And the 10% had a 1% dividend yield. And of course, we're not thinking about it that way when we're making our investments. And by the way, I should clarify that I have no issues with value funds that have a slightly higher dividend yield. Like I own SCHD, and it's in the 2% range yield, I think, although with prices coming down, maybe the yield is going up. My concern with income investors or the income investing approach is when you start to get into investments that are paying 4, 5, 6, 7, 8%, covered call ETFs because you love the yield, even though your total return is really going to take a beating. All right. VJ, where's he from? Michigan. Got it. I own VDADX in a taxable account because of an advisor a few years ago. Your opinion on moving it to VTSAX? Well, I know VTSAX. I don't know, which is Vanguard's total U.S. stock market mutual fund. I don't know VDADX. Well, this is a perfect topic because we're talking about, dividends, and I guess I do know this fund. I just didn't remember the ticker. It's the Vanguard Dividend Appreciation Index Admiral share. So I've not done a deep dive on this fund, but I've looked at it before. I think we've looked at it on the show. Let me pull the comment off the screen. Bear with me. There we go. I like this fund, actually. I don't own it. This is, I'm guessing this is tilted value, right? Yeah, not really. I mean, it's a blend. I guess it's on the value side of blend. But I don't, you said it's in the taxable account, right? So let me just make sure I got that right. Yeah. So the issue there is the yield. I mean, the yield is not terrible for a taxable account. I mean, the S&P 500 is what, about 1.2? This is 173. If we go to performance and go to distributions, so last year it distributed 71 cents on a NAV of 45. So about 1.5%, right? I don't think that's terrible. Hasn't distributed capital gains at least since 2018. So I guess if you could move from one to the other tax free, there are no gains, and so you weren't going to pay any capital gains tax. I think moving to VTSAX makes sense. I don't think VDADX is a bad fund at all. And again, keep in mind it's dividend. It's not like it's taking on some wacky investment strategy to try to get you 5 or 6% yield. And so I don't think it's a terrible one. But taxes would probably. I would not. I can tell you personally, if I had this decision to make, I would not trigger a lot of capital gains just to go from VDADX to VTSAX. Say that 3 times fast. VDADX. I won't try. Okay. Yeah, here we go. 10-year Treasury hit 2.8. Yeah. By the way, if you got out of bonds, like let's say you got out of intermediate term bonds, since we're talking about the 10-year Treasury, I guess it's right on the cusp. But this is the problem of getting out. We talk about this in stocks all the time. The market starts to fall, we get nervous, and some people sell. And then the question is, well, when do you get back in? Well, the same thing with bonds. If you remember, just not that long ago, we were complaining that the yield was so low. Now it's going up, and we're complaining that it's going up. I'm not saying that Vinyl One Earthlink is complaining. So if you get out of bonds, if you got out of intermediate term, and you put it in short-term treasuries or money market or online savings account or whatever, when do you get back in? I don't know. I mean, if you're trying to evaluate and look at valuations, you may have an answer to that, I suppose, maybe. But I think it's a tough call for most to make, myself included. All right. Speaking of bonds, Dan says, since BND, which is Vanguard's total U.S. bond fund, we can pull it up. And do I own this fund? I made some changes. I mean, I didn't get out of bonds. I don't actually know that I own this fund today, but I have, and I probably will again. Anyway, I have intermediate term U.S. bond fund. It's not BND. He says, since BND is down over 6%, would it make sense to buy more? Buying low, question mark. Yeah, I don't see it that way. I don't look at it and say it's down X, therefore it's a good buy. Because maybe it was a horrific buy before, and now that it's down 6%, it's just a terrible buy. I mean, right? And my point isn't that you shouldn't own BND, because I think if you're sort of a long-term index fund, buy and hold investor, and you've got some allocation to bonds like I do, and you're choosing BND, perfectly reasonable fund, I don't think you should change anything. But it doesn't make it a good buy right now. I guess you could say it makes it better than it was, but it's like a stock fund. It's like, ARK goes down by 20%. Is it a buy now? Well, no, it could still be a terrible investment. Maybe not as bad as it was before it dropped by. I'm just making up the 20%. How is it doing? I don't even know. It was down 1.3%. It's not at its low. It's off its low. It's at 60 bucks roughly. It was down to 52. Anyway, so I don't really view BND as a buy because it's down 6%. We can actually look at the performance. According to Morningstar, let's see here. Let me get the comment off the screen. It's down 8.33%. Now that's as of when? April 8th. So I don't know what it did today. Although we could look it up. Let's go back to the quote page. Yeah, it's suffering. So anyway, but yeah, I haven't changed my approach. I've changed the funds that I own because as some of you know, I've been trying to simplify and I'm still not done with that and not satisfied with what I have. So I may make another change, but it won't change my overall asset allocation. And it's in tax deferred accounts, so there's no taxes. Investing in a retirement account is easy. Well, easier than a taxable account. Here's a good comment from Karen. Just want to tell you that your podcast on Vanguard's digital advisor was hilarious. Thanks for the good laugh. I don't know. Was I funny? I don't. None of my family thinks I'm funny. I don't know. By the way, the little chart, if you watch that video that's supposed to show me my progress towards retirement and it was broken, it is working now. So kudos to Vanguard. They did get that fixed. And that's good. I mean, I knew they eventually would. All right. Thank you for telling me you can see and hear me. Appreciate it. Oh, look at this. This is to counter VJ's comments. Big thank you from Columbus, Ohio. OH. Thank you for your amazing videos and for positively impacting so many ordinary lives. I don't know. Have you looked around here lately? I mean, ordinary with capital O. Okay. Let's see. This is an interesting question, maybe. From Bridget. Rob Berger. Funds I might need in 18 months and looking at a mix of IBonds, tips, and a high yield savings, possibly stock. Any thoughts on allocation? Well, I have lots of thoughts on allocation. So if you're trying to come up with an investment plan, which is just a fancy way of saying asset allocation, which is just a fancy way of saying, what am I going to invest in? Step one is stocks versus bonds. And my view is for long-term investing, which is primarily what we talk about on this show. You know, you're going to, for retirement. If you're 20 years out or more, I like 90-10. That doesn't mean 100 is wrong. By 90-10, I mean 90% stocks, 10% bonds. That doesn't mean 100% stocks is wrong. Doesn't mean 80-20 is wrong, although that's getting, for me, too conservative. I would take 100% stocks over 80-20, I think. Again, for a long term, I'm in my 20s or 30s, 40s, and I'm saving and investing for retirement. So that's step one. And then once you figure out the stock bond allocation, then you've got to, okay, what are you going to invest in? Again, I like the 3-fund portfolio. I can pull up an example of it. Let's see here. How will I do that? We'll go to, yeah, well, you know what we'll do? We'll just go to Portfolio Visualizer. Let me sign in because it's got my saved stuff. I have the premium version of Portfolio Visualizer, which adds some extra tools. But again, it's kind of like Morningstar in my view. Most people don't need it. Anyway, so we can back test. We'll just back test a portfolio and go here. Actually, I think what I'm showing you here is available in the free version as well. But I have some saved portfolios. Yeah, but they have this lazy portfolio series, and they call it the Bogleheads because they're sort of the folks. I don't know if they were the first to actually describe this. Anyway, now they're using mutual funds. You can tell it's a mutual fund because it's 5 letters. There may be some exceptions, but most mutual funds are 5 letters. Most ETFs are 3 letters. There's some that are 4, some that are 2. Anyway, if you click in this, we can see this is Vanguard Total Stock Market Index, Vanguard Total International, and then they have the Total Bond Fund. This is B and D. This is just the mutual fund version. And they have 50, 30, 20. If I were a long-term investor, I would be 10. And probably I might even just do, I don't know, 55, 25 or 60, 20, maybe 55, 25. That's probably closer to what I did, although I had other, what am I doing wrong? It doesn't equal, I need more. 60, maybe 60, 30. Yeah, something like that. So, you know, I think it's a perfectly I think I think that's the starting point. In fact, I would argue, and we'll get to bonds, that was part of your question. I would argue that that was the starting point, a 3-fund portfolio, and that the only reason to deviate from it, add small cap value, add REITs, maybe add large cap value, maybe add a little extra to an emerging market. The only reason to do those things, what some will say, and this is I've probably said this, is that you might add those things and sort of tilt your portfolio in one of those directions because historically it's proven to outperform if you do that. And that's true if you're looking at the right history, not the last 10 years, but if you go back 30, 40, 50 years, of course, the problem is we don't know that history is going to repeat itself, right? Small cap value going forward over the next, 30, 40 years may or may not outperform the S&P 500. So to me, the real reason to tilt your portfolio in some of those directions is because that's what you need to do to come up with an investment plan you'll stick with no matter what happens. And if you can stick with a 3-fund portfolio no matter what happens, I think it's a great way to go. But you mentioned IBonds and TIPS. So one approach to the whatever percent you put to bonds, and I've talked about it many times, is to have sort of nominal bonds. Those are just your typical bonds, right? So like a BND or VBMFX is the mutual fund version, and put like 50% of your bond portfolio in that, and the other 50% in TIPS. Now, if you want to add IBonds, that's fine too. Of course, you got to buy IBonds directly from Treasury Direct, and it's kind of a pain, but I do it. So, but this is long-term investing. You said funds I might need in 18 months. Not sure what you mean by that. Freebird 0147 is not selling, buying more. But the question is, buying more of what? Okay, let's see what we got here. So this is from Jeff. What are your thoughts on Vanguard Wellesley Fund? Historically, over the last 20 years, returning 6.6%. I keep this fund in an IRA due to the large bond. I think it's a great fund. I mean, it's very conservative, but you could use it as part of, like you've done, put it in retirement accounts, and still have an overall asset allocation that's very different than what Wellesley is, because it's 40. We'll pull it up, but it's 40% stocks, roughly 60% bonds. I'm pretty sure. Here it is. Let me pull the comment off the screen, and we go to portfolio. Yeah, so roughly it's 55 fixed income, but then you've got some cash, and who knows what that is. But yeah, so roughly 40, 60. You could, use it in your retirement accounts, as you said, because it's got a lot of fixed income. You might have stock index funds in your taxable accounts, which is kind of basically what we do. And then your overall asset allocation, when you sort of group it all together, is whatever you're aiming for. The only thing I'll caution, I mean, Wellesley and Wellington, the Wellington's the 60/40 fund, have a phenomenal track record. I mean, they're two of the oldest mutual funds still in operation. If we look at Wellesley on the Vanguard website, let's see. So this one's 40 years old. The Wellington's older. But yeah, I mean, you look at its performance, it's done extremely well. It is actively managed. So if that is a concern for you, I don't know that given its history, I don't know that it would be for me necessarily. Although personally, I would choose an index fund. You go with Life Strategy Fund, which is Vanguard's. They call it target risk funds. You have target date. We're aiming for a date when we're going to retire, and the asset allocation changes over time as you near that date. Target risk is we're targeting a risk profile. Think stock bond allocation, and for those, the asset allocation doesn't change, right? Anyway, here they are. I don't think the hammock here, is that a chair? A chammock? I don't know. I don't think that comes with it. Like, invest in the fund, get a free swing. I don't think that's how it works, but I could be wrong. Anyway, I don't know what's wrong with me. I've been trying to figure that out for a long, long time. Let's see. Is this the one? I don't even know. Portfolio. Yeah, so this is the 60-40. See 60% bonds right there. Now, it'd be interesting. Let's compare these two. Let's pull this ticker. I wouldn't be surprised if Wellesley outperforms it. What's the ticker? VWIAX. Get rid of that. Whoops. Get rid of that. Go here. Get rid of that. Get rid of that. And we're good. I wonder how far back these go. 20 years. See, January. Good. Yeah, look at that. Wellesley's crushed it. Crushed it. So, yeah, it's a good fund. One thing I wanted to look at is, so it crushed it big time in 03. It is a question that I would have is, as an actively managed fund, and remember, it's 60% fixed income. The world of active management in fixed income is a lot different than the world of active management in stocks. So I started to say, so maybe they were able, oh, that's the wrong one. So look at this. Let me go back. I'll just shut up and show you the screen. So it's actually Life Strategy that outperformed here, but then got crushed in 2008. So it outperformed in an up year, but not in a down year. And you'll notice in all, but then here, I don't know what happened. Life Strategy's down, Wellesley's up. But in all the down years, Wellesley outperformed. I mean, by which I mean lost less than Life Strategy. But anyway, I think these are both good funds. And as an actively managed fund, Wellesley's not all that expensive. I mean, it's more than Life Strategy. Yeah, it's just 16 basis points. So it's a good fund. I don't think they offer an ETF version. So, for whatever that's worth. Okay. Here we go. I've gotten your emails, and I'm not ignoring them, although it probably feels like I am. And I'm sorry that I haven't responded. That reminds me. I think what I'm going to do on Thursday, if I can, my schedule is a little in flux this week. But if I can on Thursday, I'm going to do another live show. If I do it, it'll probably be at 9 a.m. But what I'm going to do is answer emails. And then, answer an email question, and then if anyone's watching live and you want to discuss the email and my response, you have a different perspective, I'll spend a couple of minutes looking at the chat, but if the focus is going to be on emails. Whoops. Let's see here. What did I just do to my screen? There we go. So I don't know how to pronounce that name. And you guys, I can't hear you. You're shouting at your microphone saying, Rob, you idiot, it's easy. Just say blah, blah, blah. I don't. So I'll just read the question. I am 40. And we've emailed back and forth. So I know the name. I am 40. While having stocks bond allocation, is it a good idea to have 100% stocks? Oh, yeah, this was one of your questions in the email. I actually remember it. Is it a good idea to have 100% stocks in retirement accounts like a 401k, Roth IRA, HSA, and IBonds savings accounts for non-retirement accounts? No, at least that's not my approach. Here's what I like. So we think about retirement accounts in 3 buckets. Well, not retirement accounts, investment accounts. So we've got pre-tax accounts, traditional 401ks, IRAs. That's bucket 1. Well, I won't use the word bucket because then that'll confuse us with the bucket strategy. Traditional retirement accounts. Then we have Roths, and I'll throw in HSAs if you're saving your money for retirement with the plan to use it for medical expenses in retirement. So that Roths and maybe HSAs, and then taxable accounts. So generally speaking, we don't want fixed income in taxable accounts. So, right now IBonds we'll put those aside, and because can you buy an IBond in a retirement account? I don't actually know the answer to that. Can you buy an IBond in an IRA? According to Forbes, and I don't know about their reputation. I did work there though. You can't buy IBonds with an IRA. So if you're going to buy an IBond, it's got to be in a taxable account. At least that's my understanding, and that's what someone at Forbes said. Then Kiplinger has an article, how to add treasury bonds, bills, and notes to an IRA. Yeah, that doesn't help us. Okay, so, but savings accounts, fixed income, well, a savings account, like for an emergency fund, yeah, it's going to be in a taxable account. But generally fixed income, think bonds, tips, BND we talked about, you generally don't want those in a taxable account because every year the interest, hits you in terms of taxable income. It's taxed at ordinary income. There could be, depending on what you invest in, there might not be state income tax. And I'm putting aside municipal bonds for a moment. So I like to put fixed income in a traditional retirement account, not Roth. Okay, why? Well, the expected return on fixed income is lower over a long period of time, is lower than stocks, right? Or stock index funds. And I want my Roths to get, as I've said, as fat as a tick. Why? Because it's all tax-free, assuming you follow all the rules. So I want that to be as rich as possible. And I know on my traditional retirement accounts, assuming I stay on this rock long enough, I'm eventually going to hit required minimum distributions. Now, I want my investments as a whole to do as well as possible. Obviously, we all do, right? But if I'm going to have some bonds in my portfolio, I know, or I'm going to expect their return to be, again, over the long term, lower than stocks. So if I'm going to accept that lower return, maybe for some stability in the portfolio and whatnot, I'd rather have that in the traditional. Yes, that'll keep the traditional from growing as much as it might otherwise, but with less volatility. But that's okay. That's what I'm willing to accept if I have an 80-20 portfolio or 90-10. And the fact that it's going to grow slower than if I had all stocks in there will actually benefit me when the RMDs kick in, because my RMDs will be lower, right? So, so for Roths, I like stocks, basically. I mean, I've got SCHD at the moment in our Roths, but it could be a total US stock fund. If you have small cap value and you think that's going to still, kick it into high gear over the next 20 or 30 years, and you want to put small cap value in your Roth accounts, fine, whatever. And then in taxable accounts, I just like stock index funds. I mean, VTI or VTSAX, for example, are really efficient funds. You'll pay taxes, you'll pay dividend, tax on, dividends. It's usually long-term capital gains, but it's, all things considered, pretty efficient. So I feel like I rambled, but I hope I got across at least my approach to it. So it's basically fixed income in traditional accounts. Now, you may have stock in traditional retirement accounts too. Part of it was going to depend on how much money you have in each account type, right? We don't have a lot of Roth. So, we end up with a fair amount of equities in our traditional retirement accounts. In our case, one thing that I put in there, and I put this in the class of equities, are REITs. So I'm not saying you shouldn't have stocks in a traditional retirement account, but I'd fill up my fixed income there first. I'd fill up my Roths with stock funds first. Same thing with taxable. Now, you may need cash on hand in your taxable accounts. Fine. You might have a savings account for emergencies. You might invest in IBonds. So this is not like, you can never have, interest accruing investments in a taxable account. Obviously we are, but from where do we put our major investment funds? That's my approach. Freebird he's continuing to dollar cost average. Pickings in April are slim, probably. A follow-up. Does the approach need to change as I near retirement and while in retirement? Well, if by approach you mean asset location, I'm not changing it. And I had an interesting question that I covered some time back, I think in a separate video, but it was this idea of, well, look, if I've got a taxable account and I've got all stock index funds in it, and I'm going to need to live on that for a while, maybe you retire a little early, or maybe, it's just the most tax efficient way for you to live. And so you're going to hold off on tapping your traditional accounts, your traditional 401k or IRA. You're going to live on your, the stock funds in your taxable account for 5, 10 years, whatever. What happens with the market crashes? Won't you be forced to buy, to sell when the market's down? Isn't that not what we're supposed to do? But you can fix that, right? Because in that year, when you sell whatever, you sell 50,000 and the market's been down, you're going to rebalance, right? Back into whatever asset allocation you have. And how are you going to do that? Because to rebalance in that scenario, you've sold stocks and stocks are down. Bonds might be down too, but they're not, let's assume stocks are down a lot more, which is the concern that we might have. You got to sell fixed income, sell bonds, bond fund, and take the proceeds and buy a stock fund. And you'll do that in your traditional retirement accounts. So the net effect of all of that, selling in this hypothetical 50 grand of say VTSAX in a taxable account, and then going into your retirement account and rebalancing whatever that number is, selling B&D. Let's just say you got to sell, I don't know, 40,000, let's make up a number, 70,000. And then buy, again, you might end up buying VTSAX, or maybe you're putting it in, maybe your international portfolio allocation needs to go up, whatever. So I personally, if you're referring to asset location, I don't feel a need to change it. There might be, maybe there are scenarios where you need to, I don't know. Maybe someone in the chat has a different view. Okay. Bingo knows. Hey, Rob, I maxed out my Roth contributions this year. Well, congrats. Should I increase my 401 contribution to 15% to 30%, or just invest more money into my regular brokerage account? Well, assuming this is for retirement, why wouldn't you take advantage of, the tax benefits of a 401k? That's what I would do, unless there was some other reason. I suppose, I don't know if the investments were terrible, but they'd have to be pretty bad. Or you think you're going to need access to the money, but then you're probably not investing it, you're saving it and whatever. So yeah, that's always been my approach. I want to max out, I want to max out the IRA, whether it's Roth or traditional. I want to max out the 401k. I always start with the 401k to the extent there's a match. Get the match first. But yeah, I personally, my approach was always to max out the 401k before I started investing in taxable, a brokerage account. Yes, so I'm going to cover this one too, because yes, you sent me this email. I may not have to do the show on Thursday. I've got all these emails. Well, that's not true. I've got a few hundred others that I could respond to. I remember this email as well. And I remember when I read it thinking, that's a good point. I've never actually done that yet. I have all of our receipts that we save receipts generally if they're over $100 for medical, to use them to reimburse ourselves from the HSA at some point in the future, but I've never actually done it. And so my hunch is, this is just a hunch, how do we reimburse? Oh, here we go. It's like the first Google suggest. My hunch is you want to save the receipts, obviously. That's what you're going to use to document the fact that you can take money out of the HSA. But I wonder, I'm just wondering here, this is just a guess, and I'm going to see what I can find here quickly, but if it only comes up if you get audited. Let's see here. How do I reimburse myself from my HSA from, oh, here we go, from prior year expenses. See, Google's thought of everything. HSA Bank. I'll show you this if it's useful. Here we go. Here's what it says. The question is, can I use my tax-free HSA to reimburse myself IRS qualified medical expenses from a previous year? Yes, as long as the IRS qualified medical expenses were incurred after your HSA was established, you can pay them or reimburse yourself with HSA funds at any time. Just be sure to keep sufficient records to show that these expenses were not previously paid for by another source or taken as an itemized deduction in a prior tax year. That's what this site says, hsabank.com. Is that a reputable site? I don't know. Google apparently thinks so. You know, you could also, and this is probably what I would do, is call up your HSA provider, wherever you've got your HSA, Fidelity, Lively, wherever it is. They'll be able to tell you for sure. And then you're comfortable. You're thinking, you know, yeah, Fidelity gave me the answer rather than some clown on YouTube. So have that going for you. All right. Okay. Frank, good afternoon from Alabama. Roll Tide. Zoe, my daughter, wants to know what your magazines in the back are. It's a great question. Well, this is Scientific American. It's about the quantum universe, which fascinates me, but I can't understand any of it. These are, and don't ask me why I put them up there. These are chess magazines. This is the American Chess Magazine. On this cover is Irina Krush, who is I think she's a grandmaster, or she may be an international master, but she's phenomenal. Wesley So, he would be considered a super, I would call him a super grandmaster. He's, I don't know, top 10. He could challenge Magnus Carlsen, the world champion, potentially. Phenomenal. I mean, they're all phenomenal. Speaking of Magnus Carlsen, I don't know what the get up is all about, you know, but. And then David Brodsky, who I don't really know much about. This is a great magazine. American Chess. If you're into chess, it has puzzles, and I'm a geek. I don't know. Talk about ordinary. Anyway, there you go. That's what those are. I haven't decided what to put up there. And I'm going to end up changing the orientation of this desk. And I don't know. I want to do a lot of cool things. I want to kind of create a studio. Anyway. All right. Well, so this question, I get this a fair amount. What are your thoughts around Treasury laddering? And is that some sort of tool that they use? Generally, I don't see the point in laddering stuff for the most part. And I know a lot of people do, and I'm not saying it's bad at all. They do have a bond ladder tool, and I don't know if that's what you're referring to. But I'll show everyone in case you want to check it out. This is from Fidelity. Bond ladder tool, and I've never used it. So I really can't comment on it, but you can build a bond ladder. But I don't know. I'm just comfortable owning a bond fund forever. Well, this is another one. See, I think I'm clearing out all your emails. I looked at this, and I even did a video on long-term care insurance. And I think it was around, I want to say it was around 60, but now some are saying mid-50s. So the American Association for Long-Term Care Insurance, they have an association for everything. Recommends individuals take out a policy in their mid-50s, but that's assuming it makes sense for you to take out a policy. In the video I did, I'm pretty sure I did a video. Let's look it up. What I don't remember is if it was a standalone video or part of one of these live Q&As. Let's take a look-see. You know, it was a Q&A 5 months ago. I don't know what I said. If you don't have any assets and you need long-term care, say as you age, Medicaid is going to kick in. But you know you're going to have to deplete most of your assets. But if you're in that situation, then you probably can't afford long-term care insurance anyway. And then if you've got enough assets to cover long-term care, then you don't need the insurance either. It's the folks in between, and you know, I think it's the folks in the, I'll just say generally 1 to 3 million kind of range for retirement benefits, but that's don't do anything with that number. Forget I said that number. Let me just see if I can quickly find some resources, which I probably can't. The thing is you've got to make sure you get you want someone to answer this question for you or give you factors to consider who are not trying to sell you long-term care insurance. Yeah, I'll have to do more research on that. I'm just not going to be able to come up with things quickly. I remember covering it 5 months ago. It was in, I can tell you, let's see here. So here's the video, and maybe there's timestamps. Yeah, so this was on October 28th of last year, and I'm at the 36-minute mark right here. Long-term care insurance. So Dave wants to know, what are your thoughts on long-term? What? An ad? Who put that ad there? Oh, I probably did, but not on purpose. So there you go. You can check out that video. October 28th, 2021. There's timestamps, long-term care insurance. Hopefully, I said something halfway intelligent. It's interesting, when I searched for that on YouTube, it came up with that video, even though that's not the title of the video. I guess they read the timestamps and they find stuff. So there you go. Mark wants to know, can I just buy short-term Treasury notes rather than a fund? Yeah, you can, right? If you go to Treasury Direct, I have never done it. I mean, I bought IBonds on Treasury Direct, but they would be Treasury bills, right? So, so Treasury, short term, meaning under a year, they call them bills, Treasury bills. They do have Treasury notes, which would be their intermediate term bonds, 2 to 10 years. So that's why I just make that. Oh, let me get rid of pull this down. There we go. Treasury bills, I assume you can buy these directly. I never have done it, so maybe I shouldn't assume that. But that's where you would go if you can do it. You can buy bills from us. There it is. So yeah, you can. You know, it's I don't know. I guess the question would be why. It seems like a hassle to me. I mean, I buy my IBonds that way because I don't have a choice. But maybe you just feel more comfortable owning the bond. All right. All right. Well, let's look at this. Jeff had asked about Wellesley. Part of moving into Wellesley was due to rising rates. Shouldn't this income fund pay out more? We'll move current 401k into this. Well, the concern would be that with rising interest rates, the value of existing fixed income investments will actually go down, right? Now, if we compare today with 10 years from now, or you say you're 10 years to retirement. But, the yields 10 years from now could be, we don't know what they're going to be, but they could be significantly higher. But to get from today to then, fixed income could lose a lot of value, right? And in fact, let's just look at Wellesley again. Let's pull it up. I hadn't closed this tab. I mean, it's lost 5% this year. So now, again, it's going stocks as well. So there's a lot of different factors. But I don't know that personally that I would buy Wellesley because interest rates were going up. I mean, really, it almost sounds like you've changed your asset allocation, or at least maybe. I don't know what you had before. And then the question would be why? Well, I mean, there can be good answers to that. There can be good reasons to change your asset allocation. So just, I guess, more questions. Norse, I got 14.625% on my 10-year Treasury notes in February 1982. Ah, the good old days. I actually have somewhere the paper certificate of deposit, I guess it's a receipt when I bought it 40 years ago. It's somewhere. I'm looking around like I'm going to find it. Caleb remembers 5.25%. Well, we'll see that again. All right, what else we got here? All right. I'm just scrolling through all the questions. Tracy wants to know if I have an opinion. I have lots of opinions. Do you have any opinion as to what yield on the 10-year will cause money to flee stocks? Well, some would argue it's already happening, right? The market's down. The thing is, you have to, interest rates are just one consideration, an important one, but it's hard to isolate. The media likes to tell us, the market was down today because, well, I don't know, probably a lot of things that factor into the market. And what can happen is, it's not all or nothing. As interest rates start to rise, it's going to have an effect on asset values. And, an easy way to think about it is with real estate. As rates go up, people can't afford the same house if they're assuming they're getting a mortgage. Now, that's not the analysis that like traders on Wall Street, Warren Buffett, he's looking at what do I think, what is the cash flow on an investment, whether it's a bond or a stock? What's the cash I'm going to get over the next 10 years? And what is that flow of cash worth today? I'm not going to get it all today. Now, he's not thinking just dividends. When a company makes profit, even if it keeps a lot of it, he views that as his, whatever percentage of that company he owns, because it is his. He can't control it, right? But so he's thinking about total profit. He calls it owner's earnings, which is another concept worth Googling. But in any event, what's that worth today? Well, to figure that out, you need a discount rate, right? And, you might use the 10-year. Some might use the 30-year. But the higher that number, the smaller the current value of those future flows of cash. Did that make any sense? I understand it, but I'm not sure it made any sense. So I don't know that it's not that when yields get to X, then stocks crash. At least that's not how I think of it. It's it's more fluid than that. But I think we're seeing it now, for better or worse. JD, I have ETFs in my Roth. Should I diversify with stocks? I assume you mean like individual stocks. if, for most people, I would say no. It's probably no reason to. I've diversified with some stocks, as you probably know. It takes research. It takes the ability to withstand a lot of pain. It takes the ability not to necessarily go after all the new shiny things out there. So, and frankly, it's as well as the stocks have done, I still question whether I should have, frankly, invested in them. I mean, Apple has been by far the biggest one and the best, so it's kind of hard to say I shouldn't have done that. But I don't see anything wrong with taking 5% of your portfolio and investing in individual stocks. I will tell you, when I did that, one of my rules was not a lot. Meaning, I don't want a large number of stocks. When someone tells me I own 30 stocks, I'm like, why? Just buy an ETF. What's the point? I mean, if you're going to do this because you want to maybe diversify a little bit, but more importantly, you think you can beat the S&P 500, just pick a couple, maybe just one. For a long time, I started to say I just owned Apple. Yeah. But although I did buy Berkshire shortly after I bought Apple, if I remember correctly. But for a long time, I just had two. I have four now, two of which are banks. So in some respects, I kind of look at my portfolio as if I have three, because they're different banks, of course, but they're very similar. Oh, that's my take on it. Mike, I couldn't agree more. Thanks for the session. So valuable. Appreciate it. Thanks for the topic. Folks just think dividends are free money. Wish they would listen to you and quit chasing fool's gold. Yeah, I know. What can you do? When I was an associate at the law firm, I used to say, you can lead a partner to reason, but you can't make them think. I don't know how funny they found that. Anyway, they didn't fire me, so I had that going for me. Kim, who appreciates life. Do you think an equal weighted S&P index would be better than VTI-VU in this higher interest rate environment? So really the question is, we can rephrase the question. Would small and mid-cap stocks be better than large cap stocks in the higher interest rate environment? Actually, some would argue no, that smaller companies have a harder time dealing with capital needs. But the other thing to think about is that there are some industries that will be able to weather the higher interest rates better. One thing to think, so I think of it more in terms of types of companies in my mind. So for example, let's say you're a company that has, you need really expensive machinery to run your business, very capital intensive, and you've got to replace it every 5 years, 10 years. Well, in an inflationary environment, that's going to hurt a lot. You're spending, hundreds of millions of dollars potentially on equipment, let's just say. I don't know, power company maybe, auto manufacturer, I don't know. But something with a lot of capital, a railroad, there you go. And so the prices of these things are going to go up significantly in a high inflationary environment. That would concern me more, a lot. By the way, I haven't changed my investments, but I mean, some companies in the S&P 500 will fare better than others. So I personally, so to answer your question though, is VTI still going to be a good choice? To me, VTI is, always going to be a good choice. I mean, as long as, the United States is standing and we're open for business, there'll be some times when it's a better choice, but those times will be scary, right? Those times will be a pandemic hits us, or the banking and auto and real estate industries are collapsing, right? That's when they're going to be the best choices, and they're not going to feel like it though. Will an equal weighted index outperform VTI over the next 5 years? I don't know. There's no way to know. But all that's really doing is adding more small and mid cap exposure, right? I mean, we can look at what's an equal weighted. Let me get a ticker. Equal weighted is, let's see. Oh, Vesco has one, I think. What's the ticker? We've looked at this, RSP. So if you look at RSP, it's an equal weighted S&P 500. And we go to portfolio. So an S&P 500 is going to be, the blue dot's going to be right up around here. And here it's down here. So it's tilted more value. I do like that. And but it's smaller companies. It's still large, but they're smaller. So so I look at this. Actually, I do like the valuation better. You could achieve this through other means, but will this outperform? I don't know. Its valuation, maybe. It's only off 4% this year. The S&P's off more than that. But I will say this. I'm not changing anything. I want something that I'm comfortable with for the next 50 years. I could do more research on that and think about it more. But that's all it's shifting to value. And I don't know why it's shifting to value. I mean, it must just be that the big growth companies, the big tech companies are not they're not dominating the index. So in that sense, I could see it outperforming just based on valuations. But I could be wrong. All right. Arun has a question. Are PTRQX and RLY all-weather funds? And are they overpriced to buy right now? Well, I guess all-weather is the term we're using to sort of buy and hold forever. Is that what that means? Or that they work in all economic environments? Nothing does that, so I guess it can't mean that. Well, the first one is a REIT, right? Oh, no. It's not. I'm going to have to pull this one up on the website. Bear with me. So here's the fund. Let's see if I can make that a little bigger. Oh, it's an interval fund. It conducts quarterly repurchase offers of no less than 5% and no more than 25% of the fund's outstanding shares. Repurchase offers of more than 5% are made solely at the discretion of the... So we're already getting complicated. Do I have the right PDR? Yeah, this is a different ticker. It may be just a different share class. PDR. No. I wonder if that's the right fund. Let's try this one. This is, of course, Fidelity's site. And they give you an overview. So this is what they're doing. Let me pull the comment off. It's a real asset fund. But I don't know specifically yet what they're actually investing in. Yeah. Whoops. I wonder if that's the same fund, just a different. I want to see what they're actually holding? Well, I'm just gonna assume it's the same or similar fund, because what else am I gonna do? So, they're investing in real estate, natural resources. So it's got commodities. I don't know what I know what infrastructure means. I don't know what it means in the context of this fund. This fund will take a lot of research to figure out. I guess my question to you would be, why do you think this fund, what do you think this fund will add? They're also returning, this repurchase I'd have to dig into, particularly from a tax perspective. How's it performing? So look at this. Well, this is an A share, so you're paying a sales charge for this. Maybe the one you mentioned doesn't have a sales charge. I mean, its returns, it's also a brand new fund. So, the inception date was 19. A fascinating fund, though. But that's just going to take you guys. It's interesting, these funds that you give me to look at. It's like, I'd like to say something smart about them. That takes a lot of digging into. I'd have to read the prospectus and really understand what they're investing in. I'll try the other one, but now I'm scared to look at the other one, if I'm being honest. Same kind of thing. Multi-asset real return. Yeah, so I'll tell you right now, though, you look at this fund, right? That's the ticker. Look at the yield. That gives me real concern. Again, total return. How do you get a yield of 10%, 11%, and have this be a solid long-term fund? I don't know. But I don't know a thing about the fund, so I'd have to do. I'm just not going to be able to give you. I'm not going to be able to give you anything intelligent or even halfway intelligent quickly on those sorts of funds. Oh boy, let's look at this one from Markey. I am one of the folks that got caught up in the Vanguard Target Fund. I had 81,000. I'm sorry. In capital gains and a large tax bill. Any suggestions on what to do now? I'm thinking of taking capital gains and slowly transferring funds to more tax efficient funds. Well, so I assume they filed a class action lawsuit. I did a video on that. But of course, that doesn't help you with your current investments. The one thing that I would at least look into before you incur more capital gains to get out of the fund, and this is actually in the lawsuit, that after they made, so if you know what happened, they had two share classes, an institutional share class that had lower fees, and then, a share class for the rest of us that had slightly higher fees. To get into the institutional class shares, you needed 100 million. And they lowered that. They lowered it to, I think, 5 million. So what happened? Well, the institutions that were in the regular fund, they didn't have 100 million, but they had at least 5 million. They're like, oh, I like it. Let's sell out of the ordinary fund and move into the less expensive fund. And that, to redeem those shares and move them over, Vanguard had to sell a lot of assets. That triggered the capital gains. But here's the thing. About 9 months after they did that, I'm guessing they realized the problem they had created, but I don't know that. Maybe they did it for some completely other reason. They merged the two funds together. Now, there are still different share classes that have different fee structures, but it's now one fund. At least that's my understanding. So oddly enough, I'd be less concerned about the problem today than I would have been. Well, back then I wouldn't have even thought about the problem because it wouldn't never have occurred to me that Vanguard would do that. But they did merge the funds, at least according to the lawsuit, and I think I've read that too. But you would want to confirm that. But if they have, then the risk of it happening again. I mean, they're all one fund now. Now, I guess the question would be, okay, so that exact situation won't happen again. But could Vanguard do something else? I can't answer that. I don't know what the something else would be. So I think, Marky, that's worth thinking about. Ooga digger, I guess. Thoughts on taking pension at 49 years old, $5,000 a month, and changing careers, or stay and pad the pension? 30-year government employee, should I stay or should I go? Well, I can tell you, I have a lot of friends that were in the military, and this is a different scenario because in the military, you keep getting promoted or you're gone, effectively, at least at the officer level. I don't say that from experience; it's just what people tell me. But they get their 20 years in, and then they retire, get to have a pension, and then go get another job. And I know a lot of people that's worked very well for. For me, I'm not. The real question I have for you is how much of this should be a financial decision, and how much of it should be a what do you want to do with your life decision? I mean, the money's important, so that's certainly going to be a part of the analysis. And I don't know what to tell you there. I mean, it's going to depend on what other kind of job you could get, how much you'd make, and you can imagine a whole list of questions. But to me, I think if I were in your situation, I don't have a pension. But if I were in that situation, I think the question for me would be, what do I want to do with my life? And that actually was sort of my thinking when I left. I was at a law firm, and you work 8 years as an associate to try to make partner. And I made partner, and 2 years later I left. And a big part of that decision was you got one life to live. And I've got good friends that have stayed at that firm for a long time. And I like the firm. And I ended up going back for a while, years later. But for me, it was more a question of I don't want to just do one thing my whole life. So, and I took a pay cut. Speaking about money, I took a big pay cut. And I went from a big office to a converted closet, basically. Oh, well, it worked out. So that to me, I mean, what do I know about your situation? But that to me would be the bigger question. What do I want to do when I grow up? I'm still trying to figure that out. Okay. Let's see. Narinder, I guess. Have VTSAX in taxable account and in retirement account 100%. So you're all in. You've pushed all your chips out onto the table. You're going long stocks, US. Want to keep like this forever. All right. And just use dividend only and RMD after 16 years. Presumably that's when you'll be 72. Is this a good strategy, or will I have to pay estate tax? Okay. I didn't see that question coming. Is this a good strategy? Oh, I will have to pay estate tax. Why will you have to pay estate tax? Your estate may have to pay estate tax. Well, I don't know that I have anything to say about estate tax in your situation. It's just, there's just too many factors. There's too many unknowns. My concern with, well, let's focus on the asset allocation, because effectively you're 100% stocks, 100% US stocks. Is that good or bad? Well, if you don't need to live off of much, you said you can live off of dividends only. All right, at least until your RMDs kick in. Let's look at that. VTSAX, the dividend yields what? 1.3? Yeah, nailed it. Well, close. 1.29. So if you can live off of 1.29% of your portfolio, at least based on historical data, in my opinion, if we think about Bill Bengen and the 4% rule, if history is any indication, you won't run out of money. Now, you also mentioned your RMDs. I guess one question would be, if you can live on just the dividends, why would you then spend the RMDs as well? Because you don't have to spend your RMD. You got to take it out of your retirement account, but you can reinvest it in a taxable account. But I'll put that aside. My general concern with 100% stock portfolio in retirement is that we could repeat 1929 to 31, where the stock market lost 90%. I got an email from someone, don't remember his name, but he said, Rob, does it make sense to go back that far? I mean, what's the odds of that happening again? We won't even lose 50% in stocks in a given period of time. Oh, yes, we will. I don't know if 1929 to 31 will repeat itself. Maybe it won't, but it could. And I guess the question is, do you want to risk that? But I would be stunned if over the next 40 years, the stock market doesn't lose 50% multiple times. It did in 2008, right? Not on an annual basis, but from top to bottom, I want to say it was like 53%, but in any event, it was a big number, So that will definitely happen. Will 90% loss occur? Maybe, maybe not, but that's the risk. Now, if you're only taking out 1.3%, I mean, one could argue 100% stocks. I still probably wouldn't do it personally, but those would be sort of the thoughts, the issues I would be thinking about. Again, in terms of the state tax, well, first of all, if you're going to pay a state tax, that means you got a lot of money, at least at the moment, because you get what, 11.8 state tax exemption. It's going to go up, assuming the laws don't change. For people who pass away in 2022, the exemption amount will be 12.06 million. It was 11.7 last year. But if you're married, 24.12 million. So if that's a concern to you, and by the way, well, if that's a concern to you, then you need some good estate planning. So go to a trust and estates lawyer. You can afford it, but very important and well outside my area of expertise. All right. Oh, here we go. I have PWJQX and PTRQX. I want to sell one. I'm 50, and Edward Jones purchased those in my account. Which should I sell? Well, why did Ed buy those for you? That's the question. Actually, I don't know what either of them are. Let's look them up. PWJQX, Jennison International. This is interesting. So 84 basis point expense ratio, 0 yield. What is this? Non-US equity. Price to earnings of 35. What is this fund? This is going to be one of those, another crazy one that I'm going to look at and just like, what? Don't you look at some funds and you just like, why? Why did someone even create this fund? This could be a great fund. I don't know. It's investing in non-US companies. So it's an international fund of some kind. Well, let's actually go back here for a moment then. It's an international fund. It's growth. See, so it's super growth. That's why there's no or little yield. So very large, very tilted to growth. You've got a PE of 35, and that's in an international fund where PEs are lower. Wow. I just want to look at its performance. Well, it's only lost 24% this year. Goodness gracious. Although it gained 55 in 2020. Of course, that was 2020. Anyway, so this definitely gets, I think, is a candidate. What is this one? total return bond. Well, these are, did I get that right? So these are two. So my first question, why do you only want to sell one? I'm not saying you should sell both, but why just one? That's a question. Because one's a large cap, super growth, very heavily tilted growth, international stock fund, right? This one is a total return bond fund. So it's all or almost all fixed income. For the most part, investment grade, although it's got some junk bonds here. A mix of kind of everything. Duration of 7.6. I mean, this is somewhat like just a typical bond fund. I wonder where. Yeah, so I don't know. I'm trying to understand why you only want to sell one. Just looking at them very quickly, I can't imagine ever investing in that international fund myself. So if these were the two funds, well, first of all, if you're going to sell the international stock fund, I assume you're going to put the proceeds in a different international fund, maybe like VXUS. I would certainly prefer VXUS over that fund, personally. The bond fund looks a little more sort of mainstream to me. It's not crazy expensive, but it's 39 basis points. So with just that quick look at it, if I had to pick one, if those were both in my portfolio and I had to sell one right now, which one would it be? It'd be the international fund. Whether that's right for you, I don't know. Well, here's a good question. Clarice, what intermediate? I just can't help every time I hear that name, Clarice. There was a Clarice TV show. I really liked it. And it was one season. By the way, did you guys watch Severance? I won't give anything away. The thing is the ending, by the time you got to the last, particularly after the second to last episode, you knew what was coming, right? I mean, there was I wasn't surprised at the end, but man, what a great show. Love that show. Anyway, and they have a second season coming. So what intermediate bond ETF do you own since you don't own BND? So first, let me say that I'll probably go back to BND and a TIPS fund. I'd explored and moved our retirement accounts into AOR, which is a target risk fund, just to try to simplify things. iShare Core Growth Fund, here it is. Portfolio is basically 60-40. And I used that one because when I mixed it in with all of our other investments in our taxable accounts, I got to the right asset allocation. And I like that fund or those core funds from iShares. But I'm probably, it's a trade-off. I was trying to simplify things. I still think I can keep things simple. Most of the retirement accounts will still just have one fund, but I'm thinking if I make a change, 2 of the accounts will have 2 funds. That's not too bad. And it's going to allow me to have more control over the REIT exposure and more control over the bond portfolio. And the approach I like is intermediate bonds and then intermediate TIPS. And for bonds, I'll probably will go back to BND, but that's not what iShares uses. So that's why they use let's see, where is the portfolio? Yeah, it's right here. So they use here we go. They use the iShares Core Total USD Bond Market ETF. I mean, they use others, but that's primarily, and it's very similar. So, yeah. All right, we're coming to the end. Like I said, I will do another live stream, but I'll be answering email questions, but we can talk about it too. I think this Thursday at 9. Here we go. Kim, who is still appreciating life, is your SCHD in a taxable or IRA. It's in Roth accounts, actually. So, yeah, I would. It's not that I would maybe never hold SCHD in a taxable account, I suppose, but I'd prefer not to because of taxes. It yields what, like 2 3/4? You think I would know this? It's about 2.75, right? Yeah, not too far off. It's 12 months, 287. Its SEC yield, which is sort of annualized, but based on the last 30 days, is a little higher, 3.806. And if the fund keeps losing lots of money, that yield could go sky high. So yeah, I keep those in an HSA. Or actually, I do have them in HSAs as well, but I meant to say Roth IRAs. All right, I'll do one more here. Maybe a couple more. Lance says, for bonds, would they be best placed in a rollover IRA? Yeah, I think so. Assuming a traditional, that's where ours are, a traditional rollover IRA. Yeah, I think that's a good place for them. And again, it's going to help on the RMD front. I mean, it seems a little weird to say that. It's like, I know how to keep my RMDs down. I'll put a crappy investment in my traditional IRA and it won't grow any. But we all know why we have bonds. At least for those that have them. Some of you don't, but you're probably younger than I am, although not all of you. There are some of you older than I am who are 100% stocks. I apparently made someone laugh. LOL, your comment that none of my family think I'm funny is funny. Every now and again, I get them to laugh. Oh, look at Kenny. Oh, what did you do? He sold his entire 30% position in B&D. Will buy it back in 30 days. What was there, a loss? Oh, locked in the law. You're in a taxable account. Yeah, locked in the loss to use against some future profits. It's not going to run away from me in 30 days. No, probably not. Probably not. Someone from Scotland. Welcome. It's raining in Scotland. OH, Gar, Columbus, Ohio. Dwayne Haskins, isn't that awful? If we figured out, I haven't looked lately, like in the last 24 hours. For those of you who don't know, he was a former Ohio State quarterback, was drafted by the Washington Redskins, the Washington football team, the Washington Commanders. I want to call them the Commodores. And then he got moved over to the Steelers. I was really looking forward to seeing him play. And then he was killed, apparently crossing a highway at like 6:30 in the morning in Florida, where he was training with some of the Steelers, and got hit by a dump truck or a trash truck. I don't know. And the question was, it's awful. Apparently a great guy. I don't know anything really about him personally. But apparently, I don't know if they know why he was he's apparently walking on the freeway. Anyway, terrible. Perhaps the best investment of the night, Slim Dog Pizza. So speaking of pizza, I'm actually doing the opposite. So I got this app, MyFitnessPal, and it tracks calories. So I'm not a big calorie counter, but I used this app 2 years ago, for a while. You can track your weight, and you can track all of your food. It is pretty cool because it comes up with a calorie for the calorie count. Like mine's 2390 for the day. I think it's based on, I guess, age, gender, height, weight. I don't remember. This is a couple of years ago I set it up. and it tracks your food. You have to put it in, but it's very easy to do. You could scan a barcode. I scanned the barcode on my quinoa tonight. I couldn't believe how many calories are in that. Wow. Anyway, if you're like, I'm at Starbucks, I get an Americano. It's got like 10 calories, but you can type in and it'll pull up the Starbucks menu and you put it in. It also then pairs to the Apple Health thing and app, and I've got the watch. So it tracks your exercise and subtracts. I think it's what they call your active calories. I guess those are calories over and above what you would burn if you were just sitting on you're sitting around doing nothing. Anyway, and then how many calories you can still eat. And the reason I did this is I have weird weight fluctuation, health issue. But it's like, it's gone up like 7 pounds this winter. And I don't eat processed food. I don't eat refined sugar. I mean, rarely, once a month, maybe. It's usually for, special occasion or something. I don't eat breads for the most part, pasta. So it's a very sort of, I focus on my nutrition, and I'm gaining weight, and I'm like, so then I'm thinking, well, it's my metabolism. And then I was like, oh, Rob, shut up. Your metabolism didn't drop in 2 months such that you gained 7 pounds. And when you start to count your calories, and you're thinking, okay, I'm just used to grabbing a handful of almonds. I don't count them. And then I'll grab another handful. And when I want to put almond butter on a banana, I'm not, measuring out 2 tablespoons. I can tell you that. Well, turns out those things, maybe they add up. Anyway, what did this come from? Oh, pizza. Yeah. Yeah, pizza would definitely put a dent in my allowable calories. But now, I had pizza this weekend. I'm not like crazy insane about this stuff. My wife and I went to the beach. And we get ice cream on the way there and back. The folks that live near Ocean City will know this. It's I can never remember the name of this place, but if you're going to Ocean City, Vanderwind. Vanderwind. Oh, it's great ice cream. There it is. They have locations like in Ocean City and Rehoboth as well. Their main location's in the middle of Delaware. And the thing is, when you go there, if you just want, I get one scoop in a cup, but it's not like the Ben and Jerry's scoop that's like this big. It's like massive. It's ridiculous. And I had pizza, and then there's a great deli in Ocean City, Rosenfeld's, right? Oh, this place. So I was a big fan of Carnegie's. Anyone go to Carnegie's? I know I'm sort of off topic now. Kind of tired of talking about money. So Carnegie's was my favorite in New York City. It's near Stage Deli, which I don't know why anyone would go there. That's just my opinion. But Stage closed, or not Stage, Carnegie closed because of rent issues. I was going to New York, I don't know, a year or two ago. Get off the train, head up it's in Midtown, firing up there ready for my corned beef sandwich, and I get to the door and I'm pulling, locked. I'm like, what's going on? Unbelievable. But Rosenfeld's in Ocean City, they have other locations. Here it is. This is a different location because the one in Ocean City is a hole in the wall. But I'm telling you, they rival New York delis. I'm telling you that right now. Now, when I'm in New York, I'll go to Katz, When Harry Met Sally, that deli, and Second Avenue is good, but Rosenfeld's is every bit as good. So, I do splurge. Okay. What else we got? Maybe I'll finish with one last money question. I should scroll down to the bottom because I miss what you guys, I say these things and then who knows what you're saying. I'm so far up. All right, here we go. Karen, do you think Tesla is a good investment? I don't think Tesla is a good investment. But let me explain why. So obviously, if you've been a long-term time investor in Tesla, you've done very well, even with its ups and downs. Obviously, Tesla has made folks a lot of money. And there are always going to be investments that, if you time it right, have made folks a lot of money that I personally won't invest in. The issue for me with Tesla, let's talk about the good things. One, it's in a growing industry. Presumably, we're headed towards electric vehicles. That, by all accounts, that's what's going to happen. That's where we're headed. I want one. I don't have one, but so it's in a great industry. I think Elon Musk, for the most part, is a very positive thing for the company. He has his less than best moments from time to time, and he's caused some trouble for the company, largely with things he tweets about. By the way, did you hear he's going to be on the board of Twitter? And now he's not. Okay. That kind of thing, and there might have been reasons for it, but I don't know. There's just always a circus around it. But he's obviously a brilliant guy. And I think all in all, it's a positive thing for the company. And in my opinion, it has the best electric vehicle on the market today. Now, I don't know that will always be true. There have been two things that have kept me out of Tesla. One is valuations. It's just been incredibly, the valuations are just off the charts. And so I don't feel like I have a safety net with Tesla. I like to see valuations that are much more reasonable in relation to, say, profit than what a company like Tesla is going to get, which means I tend not to invest in the popular companies. Now, I own Apple. I bought it at times, though, when people were running from it. Go back to 2013. Price dropped from around 700. This is before a couple of splits, to under 400. And I said, yeah, I'll take it. But it means that I tend to stay out of the kinds of companies everyone's talking about. So I've never invested directly in Amazon. If I'd have done that at the right times, I'd have made a fortune. So it's valuations, and it's just uncertainty. There's a lot of uncertainty in the industry, and I think with Tesla, it could continue to dominate, and maybe it will do very well. But I think the day is coming, and we're getting closer, when it's going to have a lot of competition from a lot of companies, including other companies that have entered just the electric vehicle market, and then the Fords of the world, and GMs and Mercedes, and if we get to that point where basically all cars are moving, or all companies are moving in the direction of electric vehicles, I don't know how that's going to play out. But there's just, for me, too much uncertainty. So I don't think Tesla is it's not the kind of investment that I think I can consistently make over time and do well. If I want to invest in those sort of high flying companies, I might hit some home runs, probably going to strike out a lot too and lose some money. And I think all in all, I don't see how I can consistently make money investing in companies that are trading at just crazy valuations in an industry that's still very young and subject to all kinds of unknowns. I mean, there's always unknowns, right? So I can't eliminate the unknowns, but I'm trying to limit them. So it's just really contrary to my approach. Now, one thing, you talk about valuations. I remember I interviewed Guy Spear, who you may know. He runs a fund. I'll show you. He's a great guy, really nice guy. He's one of the guys that had lunch with Warren Buffett back in the day. Here's his website. But I remember he's a value investor, right? So he's looking to buy companies that he thinks are undervalued. And I remember on this podcast, this was years ago. I don't know. This was before I sold Dough Roller. So this was like 2017, maybe. He made the argument that Amazon was a value company. And I don't remember his reasons for it. I'm trying to remember how much he explained on the show. But I remember at the time thinking, I just don't see that. And boy, Amazon, what's Amazon done? Let's take a look-see. if I'd just listened to him. My point is that it's not always easy to find value stocks or to understand them. And just because it's a low PE doesn't mean it's a good investment. And just because it's a high PE doesn't mean it's not a value stock. Still, for me, Tesla is just, I just don't need the excitement. So how has Amazon done since 2017? Well, it's had a compound annual growth rate of 32%. Now, how is the S&P done? Yeah, so it's crushed the S&P. Oops. I'll put Tesla up here too. Let me just get rid of the comments so you can see it. Obviously, been a great investment. I guess I guess it's kind of, I don't want to call it flatlined, but since the COVID bump, right? And of course, no one could have predicted that. I don't think. So let's put Tesla in, and then we're going to call it a night. It's probably crushed both of them. Look at that, 10,000 in 2017. So it shows you what I know, right? I mean, why would you guys listen to me? I have no idea. You have to figure out your approach to investing, particularly if it's not going to be just, 3 fund portfolio and you're done. But whatever your approach is, you have to recognize that the hardest thing, one of the hardest things in investing is sticking to your approach. Because it's always going to be the case that some other approach is making more money, or almost always, right? It's just the nature of the beast. So Tesla's proven, it's obviously done extremely well. Although, the other thing you have to look at, Tesla is the orange line. So it was basically flat for 3 years, did nothing, and then went down. And then you get up to January 2020, and it's still not, it's I guess it's at that point it's keeping up with the S&P 500, but it's well below Amazon. And then it just took off. So, some people made a lot of money. I am not one of them. I was unhappy when it entered the S&P 500, but time will tell. So I'm not a huge fan of Tesla as a long-term investment. But I could be wrong, and you could make a fortune. So there you go. Well, listen, I appreciate everyone joining tonight. I will, like I said, I'm going to answer some email questions on Thursday, I think 9 a.m. Again, my week's a little bit in flux, but hopefully that will work out. And for those that join live, we can have discussions around those questions. I'm sorry, as always, I don't get to all your questions here. By the way, feel free to email me, but I will tell you that the questions for Thursday are already set. So, or I haven't set them all, but they're all based on emails I've already received. But I may do that weekly or every other week. I'm just coming down here to see if there were any last comments on, like, I don't know, the best delis. I wish we had a good deli in Washington, D.C. What's the best deli in the Washington, D.C. area? Shredder says, I don't need an app for pizza and ice cream. Yeah, if that's what you're going to eat, you definitely don't want the app, because it's not, the numbers are not going to look good. I did not discuss IBonds, Dan. Yeah, I don't know why. I mean, I get that argument about when to buy them. I don't know. I think there's some strategies if you plan to sell them after a year, but that's just not how I think about it. It will be interesting to see what they reset at. When does inflation numbers come out? I know I keep saying I'm going to end the show, but I don't know. Inflation, when is this? What's the schedule? April, tomorrow. The numbers come out tomorrow. I've heard they're going to be over 8%. I'm telling you, IBonds are going to rock come May. They reset every 6 months based on CPI. All right. I think I've come to the end. I'm getting tired. All right, gang. Thank you as always. Like I said, I think Thursday, 9 a.m. with some email questions. And I'm going to have some other videos out this week too. I should, including one on Roth conversions that I've been meaning to make. And I'm trying to figure out the way to communicate what's up here into a video that's not 4.5 hours long. Roth conversions, they're complex, but once you understand the concepts, they're very easy, I think. Anyway, that's it. Have a great night. Until next time, remember, the best thing money can buy is a good corned beef sandwich, but also financial freedom, which then allows you to buy the corned beef sandwich. Okay, whatever.